Hey guys, welcome back to another video. Today we're going to be talking about communication and M&A. And when you think about mergers and acquisitions, you think about the valuation side, the negotiations, and the blow-ups when it comes to clashing cultures. But communication is something that's very, very important and oftentimes ignored beyond the initial announcement of the deal to the public. Communication in the deal process starts at the very beginning of idea generation, when you're first considering these target companies. At that point in time, you want to be communicating not only to your internal people, but also key stakeholders and advisors who can help you in the deal process. And it goes all the way to the end, all the way to when you're integrating that business, that acquisition into your business, because you got to be communicating about key milestones in the deal process to your employees. Now, those employees are both your previous employees and also the ones that you just acquired. So communication is very, very important. Now, there are three pillars to success in M&A. There's planning, communication, and people. Planning involves the planning and really execution of the deal. It starts with really generating the idea, planning how to structure that deal, valuing the deal, valuing that business, and then executing on that and negotiating for that acquisition. Especially also the integration side. With people are the soft issues of M&A, and the ironic thing is that those soft issues are actually the hardest issues in the deal, because most of the time these intangibles like culture and perception and values are ignored and really can't be valued on the balance sheet, but are absolutely essential to the integration of that acquisition in your business. And the third pillar, which we're going to be talking about today, is communication, and it relates both to the planning stage and the people stage. It relates to generating the ideas, it relates to negotiating that and communicating to key advisors, and at the same time, the integration of those businesses and the people side, communication is important to be connecting with those people and their values. So from the moment a CEO starts thinking about an acquisition strategy through the announcement of the deal to post-merger integration, a high-quality communication plan that takes into account all stakeholders is very important. And so what are the stakeholders? Well, there's regulators, competitors, employees for both organizations, shareholders, institutional investors, which can be big blocks that own big blocks of shareholders, so they own a large percentage of the company, and activist investors who really have a strong voice and influence over your board and really your strategic direction. Now, the purpose of communication is to manage expectations and refine your own strategy. So whenever you think about communication in M&A, it's managing expectations. Before you even have a deal, you manage expectations with your investors on a day-to-day basis, on a monthly basis, right? If you sit down with key stakeholders, you update them on your strategy, right? Essentially, that's managing their expectations of where they think you should be versus where you are right now and what you want to do as the CEO of your organization. And at the same time, through communication, you can get feedback in order to refine your strategy. So sometimes, one of the best examples is you go to your institutional investors and you ask them, hey, I'm interested in pursuing this M&A strategy. I recognize the strategic benefit. It can really accelerate my growth in a respective market. What are your thoughts? And you have to be, of course, careful with disclosure requirements. You don't want to provide any insider information, but as long as it's a strategic overview, these institutional investors are specialized in that area. So you can actually leverage their expertise because you are in a relationship where both of you want to add value to the organization, right? And so that's the beauty with communication. It doesn't just start on the day of the announcement of the deal, but it starts months before. So let's talk about some key stakeholders, employees. Well, communication helps to mitigate risks by proactively addressing the fears and concerns experienced by the people of both organizations involved in the deal. Most deals get done without the knowledge of a majority of the employees of both firms. Thus, the day of the announcement is likely to be the first time employees of both firms will find out. The market and most people don't like surprises, so it is important to craft a story about the reason for the deal, what it means for employees, and how it's a win-win for both sides. And I made a separate video, and I recommend that you watch that as well, about the HR side, about really the culture, the people pillar. And when I talked about the people pillar, what really the focus was, it was on not us versus them, but us as a group. like we are merging together rather than, company A, as if I'm a company A employee, oh, we're buying them, because that will always create the divide. But if you're able to communicate that win-win scenario where we all win, then really it becomes much easier to integrate both groups of people. Now, institutional investors are also important. For publicly listed companies, institutional investors can make or break an M&A deal. Communications with institutional investors who hold large blocks of stock should begin in the idea and strategic phase. Cognizant, of course, of disclosure laws, any major moves such as an acquisition or divestment should be signaled to investors well in advance and be part of the corporate strategy. By briefing them ahead of time, any confirmed move announced will not be unexpected. So surprises can alienate investors, especially if it is a large shift in strategic direction. Think of it this way. Imagine that you are a fund manager or a portfolio manager or hedge fund manager, and you hold 10% of this company's outstanding stock. And all of a sudden, you find out on Bloomberg News that company is completely shifting direction. They're going to be focusing and investing a large amount of the money that they generate in a completely new market, and you were not even briefed on that. But I own 10% of the business. You should have sat down with me. And again, we're not talking about specifics. We're not talking about the actual deal, the actual company that we're buying. But you, as a senior executive, are able to sit down with these key institutional investors and talk about strategic overviews. Talk about these strategic directions. I'm interested in expanding in this market. What do you think of that? Oh, well, based on me as someone who has skin in the game, I feel that that's either good or bad, right? And you kind of refine your expectations. And once again, you're communicating with these institutional investors in order to manage their expectations so that when a deal is announced, they're not surprised and react negatively. Because you don't want to piss off a portfolio manager or fund manager, because then they're going to get their buddies to really rally up on you and ask some seriously tough questions, which will slow down the success of that deal if it will become successful. Activist investors are, and again, that relationship between activist investors and institutional investors is really difficult there, because if institutional investors are pissed off, I'm sure activist investors will already have been pissed off when the deal is announced. So activists tackle a range of issues from underperformance to poor governance, and they're going to be citing that. They're going to be engaging in a proxy battle, whatever it takes to really reject that deal or avoid pursuing that deal, again, if they get caught off guard and don't like the deal, which is most likely the case when they are not prepped and communicated with. But often they seek to persuade management to drop a takeover that they feel undervalues the company to be acquired. In some cases, they will go to the board with the threat of going public or directly come out in the open with their recommendations. The key is to manage these relationships and take their views into consideration. So let's look at the timeline for the communication strategy. There are 4 key phases. There's the idea phase, where really you have a target of companies, and really the M&A strategy, essentially what happens is a company considers that, okay, yes, we're going to keep our options open and we're going to be following up to maybe 100 companies, 100 public and private companies in our industry or potential acquisitions, and we'll have that active deal list, and we'll kind of funnel those ideas to really 5 or 6 key companies that we're going to be keeping our eye on. And again, at that point in time, you can speak with your institutional investors and run this idea. Hey, I'm interested in making an acquisition in this area. This is kind of the group of companies that I'm considering. Now, of course, you wouldn't want to name names, but at the same time, as long as you name that direction, it's good. And so that idea phase happens 12 to 18 months before the deal is announced. So you want to communicate with key stakeholders and keep management informed. Then there's a pre-deal phase where you actually are engaging in conversation with the company that you want to acquire, conducting due diligence, going through the negotiation process. And so that's where you start building your story. You want to, as you're going through the negotiation process and due diligence, you want to identify key things that you want to communicate to the public once the deal is announced that really resonate with what they need and what they want to hear. Now, at that same time, you can also hire a PR team, and stats show that if both the acquirer and the seller have PR teams, the completion rate increases significantly for the deal. So that's really important. And so that's usually when you hire them. You don't hire them 18 months away. Sometimes, you have your own internal PR team, but you also want to hire external advisors. And relative to the value of the deal, believe me, the cost of hiring a PR team is very, very low. Now, you can also prepare a leak contingency plan. And so if the deal gets leaked before your intentioned deal announcement date, then you really need to be prepared for that. And we'll talk about that. Then the deal announcement phase. And this is where you really want to raise some concerns about when you want to time that announcement, how the initial press release will be, managing the expectations following that press release, and really most importantly, communicating synergies. Because in that initial press release, when you announce the deal, one of the big things that investors always look for is synergies. And then the final is post-deal. So usually about 100 days and sometimes even longer. And so that 100-day period is supposedly supposed to be where you really kind of work out the kinks, fire the people that you need to fire, integrate the two businesses. And so by the 100 days, you're kind of trying to work together more successfully, right? The first 100 days are tough, and it takes a lot of pushing and pulling to really get the two organizations to fit. But again, if a deal is successful, then this integration phase is smooth, and you want to constantly communicate successes, achieve the milestones to both the organization and external stakeholders such as institutional investors. So building the story. So research shows that it pays to pay public relations professionals. A study examined 198 large public-to-public UK M&A deals from 1997 to 2010, so it's fairly recent, and found that deals with PR firms on board had a higher chance of completion. So if both the acquirer and the target had representation from the PR firm, the deal was 74% of the time was completed versus 7% of the time, 74 deals out of these 81 deals that were considered. Only 7 of the 81 failed to go through when both the acquirer and the target did not have a PR firm. But when there were no PR firms involved with either the acquirer or the target, 15 out of the 47 deals actually fell through. So the percentage of deals, the success rate was much lower when PR firms were not involved. So when PR firms advised both the bidder and the target, over 90% of the deals were completed successfully, compared to those without PR advisors, where only 2/3 of the time it was completed. Now, PR advisors play a very important role in the M&A strategy and need to be sufficiently well connected to management to do their job properly. It's not only about talking to journalists on the day of the deal. It's about spending time helping the company communicate its long-term strategy to a range of stakeholders. So both management and key external stakeholders that are expected to be asked about the deal once the deal is made public need to communicate a clear and consistent message. So this is like rule number one, especially when it comes to communication. On the day of announcement, if you have the target CEO communicating different things than the acquiring CEO, then right away people are like, what do you mean? Well, he's saying that and you're saying that doesn't make any sense. So that's kind of easy to understand. But over time, if you're changing your story, then you're not building your story, you're losing trust in your story. So you want to make sure that from the very beginning, all stakeholders that are involved in that transaction are able to communicate clearly what the message is. That means advisors, that means institutional investors who are going to be asked publicly whether they support or really deny that deal and reject it. So it's important to really have that clear and consistent message. And building that story starts in the pre-deal phase, six months before even the deal announcement. So another big concern is the timing of the announcement. So the timing of the public company deal announcement is also very important. So deals announced before the start of the trading day were more likely to be completed than those announced after the market opened. So deals announced between 7:15 a.m. and 9 a.m., so before the market opened, had the highest completion rate at 87%. And this fell to 64% completion rate after 9 a.m. So if a deal was announced at 10 a.m., so the rate on average of completion would be 64%. And so why is this? Well, because an announcement after the market is open is more likely to be made in response to a leak or rumor, and thus not one that was planned. So the case that was looking at this, essentially, most of the time when you have a deal that leaks, that's unintentional, and all of a sudden it hits the market, and again your shares react to that, management really wants to jump on that. And if they don't do that, then the message that the deal is giving to investors and shareholders can really change the investment proposition. And so many times when management is not controlling that communication channel, the deal can actually fall through simply because investors don't understand it, or if they're just nervous about the deal and therefore they reject it. And so that's why the completion rate's so low. Now, the initial press release. So on the day of the announcement, the content of the initial press release is critical, as it will set the tone for any subsequent media coverage. First impressions are important, as it sets the initial tone of the deal. Even after the first statement, merging companies need to keep control of external and internal communications. Setting up a two-way communication strategy helps respond and control expectations. And once again, that's most important with communication. And a good example, so often large companies will set up end-of-week PR meetings. And a good example is when Kraft Foods was buying Cadbury, the chocolate maker. The CEO and his PR team would sit down every Sunday, and they would read this week's press releases and headlines from the Business Journal and Wall Street Journal, and they would read that, and they'll see, okay, how can we respond to this? Is the information more pessimistic or optimistic? What can we release in order to really control sentiment surrounding the deal? And that was done every week, and in order to really control next week's sentiment. And so by responding to how the market responds in a way, using that two-way street, you're able to really control and manage expectations. If you just announce a deal and then people respond to it and that's it, well then the way people respond is not really controlled by you. You can actually control the way people respond by offering more and more information, therefore improving the confidence of investors, especially those who don't really understand the deal. So setting up that two-way communication from the start of the initial press release is very important. Now, one interesting thing, I found this very interesting, is the unintentional leak plan. So a deal that is well understood will be well received, but unintentional leaks can be annoying and damaging, as they are usually partially true and miss key points in the investment rationale. Usually companies prepare for a potential leak by setting up a contingency plan to quickly counter and change the perceived nature of the deal. The more time an unintended leak is left alone, the more damaging it can be. This strategy can be a prepared statement that is quickly released in order to quickly cap off uninformed opinions. So this happens not as often as you'd think. Most of the leaks are intentional, and I'll talk about that in the next slide. But when there's an unintentional leak, you as management really want to be prepared and quickly. So if all of a sudden on Bloomberg you see, boom, your company's buying company X, you want to already have a statement or be prepared to give a quick statement right away, because the more news articles pick up on that, so the more other news stations pick up on it and report about it. And if it's uninformed and it's not really clearly communicating your investment plan, all of a sudden a bunch of people know about it and they're basing the information off incorrect information. So it's better to quickly respond to that leak and really inform Bloomberg or Thomson Reuters that, hey, no, you're kind of right on that, but you're wrong on this. This is what it actually is. And although it's not according to plan, it's better than not responding at all. And so you want to have that plan. Now, what about deal leaks? Well, leaks are an effective tool for both the buyer and target. It usually happens later on in the pre-deal process when one side is unhappy with how the deal is progressing. So leaks can actually be intentional, and most leaks are. So for the target, they can use a leak as a way to speed up the completion of a deal during the due diligence process or force a counterbid to create this competitive bidding environment. The buyer, on the other hand, can use a leak as a way to back out of a deal during the due diligence phase if they begin to cool down on the prospects of the potential combination. And of course, when you look at both sides can really benefit from deal leaks, the downside is the benefit of the other party is the downside and the disadvantage for the party that's considering the leak. So for the target, if they want to really speed up the due diligence process and they intentionally leak the deal, the risk is, what if the buyer kind of looked at the initial data provided in the data room and they're like, hey, you know what? We don't like this company. We should probably back out somehow. And all of a sudden, the deal's leaked because the target leaked it. Hey, there you go. That's your out. We back out because, we weren't able to complete our due diligence properly and in private. And with all this market pressure, we're backing out, right? So that's it. And so that's what research shows. Research shows that 5 out of 10 advisors thought leaks could be good for their client. However, 9 out of 10 recognized that the strategy could backfire under certain conditions. Now, the benefit with deal leaks is that the same study found that leaks on average have a positive 18% impact on the takeover premium, an 18% increase, which can equal billions of dollars in certain instances, most likely millions. Now, this remains an attractive alternative for both sides, which needs to be considered in any communication strategy. Now, a legendary investment banker by the name of Bruce Wasserstein, bid him up Bruce, is one of the perfect examples of big famous investment bankers who are publicly recognized and frequently leak deals to their clients' advantage. And he was one of those guys that could really pull the right levers in order to increase the takeover premium or force bidders out of the bidding process. So this is an effective strategy, and I wanted to reference it when you think about communication in M&A. Now, one of the big keys in that initial press conference is communicating synergy. Now, one element that investors is focused on is potential synergies to justify any premium paid for the target. The argument for synergies must be made crystal clear. If not, you risk people ignoring your entire investment argument. And so the big questions are, will the target be fully integrated or kept as a separate division? What will the timeline be for achieving these stated synergies? How will the business model change? And what will be the cost to achieve these synergies? And when are these costs incurred? And I cannot tell you how many times I've sat down with my investment team, with the investment firm that I work for, and we're looking at a deal, and the first question is, I don't believe these synergies, or like these synergies just don't make sense. They're not, and most of the time it's because they say, we have $500 million in synergies, which will be recognized over 3 years. Well, that's not a lot of information. If you really want to communicate and really convince people about those synergies, you need to offer more information. And that's why communicating synergies are very important in M&A. Now, what about the post-deal side? Well, post-deal, you want to continue to align the communication strategy around key deal milestones by reviewing changes in the new merged organization. Now, common milestones in the post-deal phase of M&A are, merging business processes and system integration. So HR, IT, the corporate finance department, the treasury department, all of these different departments that are merging together, you want to recognize that. And that can be simply from communicating that, our email system is about to change, or all the way up to the benefits and the packages offered to different employees. So it really depends on you communicating that to employees so that they get a sense of, hey, this is actual real change that is positively affecting me. And at the same time, remember that two-way street. So if you change the email of that organization and people get pissed off, well, respond to that. Don't just let them get pissed off, because then they'll start blaming other problems on the acquisition rather than really what the real problem is. In addition, it can be organization design and workforce, and that can be just the hierarchy of the organization and that changes in different titles. It can be the external brand and messaging, so the culture of the firm and how it's marketed, and it can also be the combined go-to-market approach. And this is one of the biggest deal milestones, and this is especially when you're talking about revenue synergies. You're merging two businesses to take advantage of leveraging one business's product with the expertise of another business's market, right? And when you're doing that, that, you want to really communicate the collaboration these two shared organizations were successfully able to implement. And that communicates to the rest of the organization that, hey, this deal worked out well. So there's a lot of communication in the post-deal side. But I would recommend that you watch the people pillar video, that human resource considerations in M&A. That's another video on my channel for more on this side of the discussion. Other than that, some key takeaways. Now, it's important to keep key investors in the loop because they can derail your deal, and especially institutional investors and activists. You don't want to surprise the market. The response will probably be negative, so you want to really communicate at that initial press conference all of the clear synergies and at the same time how the business is changing and whatever it is, so that the market fully understands the investment proposition. You want to ensure you have a communication strategy set up in a two-way system, which is most important. You also want to understand the concerns of internal employees and communicate changes clearly. And you want to pay attention to key external stakeholders' concerns, such as regulators and activist investors. And I didn't talk about regulators a lot because it can get quite complicated, especially if you're in different markets. But that's another side of the discussion, because with regulators, especially if there are antitrust concerns in your deal, you want to make sure that you're communicating with them, because most of the time regulators will tell you early on, hey, we're really iffy with this side, or we're really iffy with that division. That doesn't really look good. And respond right away. Be like, hey, we acknowledge that. How can we change that? Do you think that if we divest it, you'll allow us to really complete the deal? And so it really speeds up the approval process. And at the same time, you don't get caught off guard all of a sudden looking at, hey, why did they reject our deal based on antitrust? Because they were communicating to you and you needed to communicate back and acknowledge them. And so that's really important. Other than that, that's pretty much it for this video today. I appreciate all of the support on the channel. And if you have any questions about this video on communication and M&A, please do comment below and I'll be sure to get back to you as soon as possible. And as always, if you like the video, please like and subscribe to the channel for more. I appreciate all the support and I will continue to make these videos. Have a great day, guys. Thank you.